Hello, this is Dale. In this video, I'm going to be discussing how I earn 20% per month trading credit spreads on a consistent basis, only spending about 10 minutes a day to do this. I've been doing this for many years. Once again, my name is Dale Brethauer. I've been a trader for greater than 4 decades, hedge fund manager. I'm very proud of the website www.optionsinfinity.com. I teach people how to trade credit spreads for consistent profits. I believe this is one of the best ways for retail investors to earn consistent money from the stock market in bull markets and bear markets. I utilize 3 indicators. These are very powerful indicators. There are a lot of indicators out there, and the more you use, the easier it is to have them blend to your analysis. These indicators, measured moves, Fibonacci extensions off the measured moves, and regression channel, I believe are the best indicators to give you a good picture of what might be happening in the future, and that's what trading is all about. Measured moves, first of all, the classic definition of an uptrend is higher highs and higher lows. Classic definition of a downtrend is lower lows and lower highs. Well, a bullish measured move then is with the price coming down and it comes up from A to B, then pulls back to C. It makes a higher low and then makes a higher high here when it crosses the threshold at B. This is a confirmed measured move to the upside. And as long as the price continues in this direction, you will continue to have measured moves, and that continues to show you that we are in a bullish trend. This is for any time frame. On the other side, bearish is the price is coming up, it pulls down, comes back up here, but it makes a lower high, and then a lower low, confirming this is a bearish measure move to the downside. This is a very powerful concept. And I tell all my new mentees that this is the crux of the strategy that I use. To please study this and try it on a couple different stocks on the daily charts and see if you can see measured moves and see if you can see how the trend develops and so forth. Once you have a measured move, then you can, well, this is an example of a down measured move. It comes down, comes up here, makes a lower high, and then a lower low, it continues on down. This is a Fibonacci extension. Once you have the measured move developed, you can put on a Fibonacci that kind of gives you an idea of when that movement, you might want to take profit. It might be a little bit overextended. Here's a measured move to the upside. Price goes up, pulls back, makes a higher low, then a higher high. This is a measured move to the upside. These happen all the time. Now, like I said, once you have a measured move, you can put on a Fibonacci. Well, what is a Fibonacci? Fibonacci came up with a number sequence way back when, where he took the previous number and added it to the next number, and it came up with the next number in line. Like 1 + 2 is 3, 2 + 3 is 5, 3 + 5 is 8, and so forth. If you divide any number by the next number, you'll get what they call the root Fibonacci ratio, 0.618. 0.618 is found throughout nature. The stems on a flower, the leaves grow at a proportional distance to that ratio. You can look at the spirals on a seashell, and they are proportional to the ratio. Look at the bones in your body You take the distance from your forearm to your hand, and then from the wrist to the end of your fingertips. It'll be proportional to the Fibonacci ratio. My hand is 7.5 inches, forearm 12.3 inches. That gives me a ratio of 0.61. This is true with all the major bones, et cetera, et cetera. So doesn't it make perfect sense that what fuels the market is fear and greed and human emotion? It makes perfect sense that the market would move in perfect harmony with nature, and the Fibonacci's will give you an idea of when the price has moved and is a little bit overextended. I use the 1.27 and the 1.61 as my major extensions. Sometimes I use the 2.61. The last indicator I use is the regression channel. Regression channel is a very powerful tool. The mean of the regression line is calculated by 50% of the price above and 50% of the price below. So this is an excellent trend line. Once you have that established, you can give the plus or minus 1 standard deviation, plus or minus 2 standard deviations. Plus or minus 1 standard deviation will show you 68.2% of all prices will be contained within that channel. The plus or minus 2, it's 95% of prices are contained within this channel. That tells you definitely when something is overbought and oversold, and when it's time to look for a measured move to revert back to the mean. These tools, these 3 tools, allow you to really have an edge over other traders. Now, what I want to do is I just want to go through a little exercise, and I'm going to use a year on the SPY, the Standard & Poor's 500. And I'm going to look at, first of all, buying and holding. The second thing is we're going to buy and sell on measured moves. The third is I'm going to use measured moves and then get out when I get at the Fibonacci of 127. And the fourth one is I'm going to have the first 3. I'm going to buy on measured moves. I'm going to exit on the 127. But when it gets close to being overbought, oversold on the regression channel, I am not going to take the trade. So let's see how this develops. Here's the chart of the SPY, and this would be buying and holding. It starts out here around 395. It ends up the year around 425. This chart shows some of the major measured moves that occur during this trading year. And what I'm doing is I'm going to buy when you get a measured move, and then here I'm going to sell on a measured move, buy on the measured move, and so forth. The next chart, what I'm going to do is when I get to a Fibonacci, remember when I have a measured move, I can put in a Fibonacci. When I get to a Fibonacci of 127, I'm going to exit the trade. Okay, so here's the measured move, and here would be the exit. Here's the next measured move, and here's the exit, and so forth. And the last one is I'm going to put on the regression channel, and when it gets above the +1 and below the -1, I am not going to take those trades. So let's rack this up and see what happened. If for buy and hold, the annual return was 4.8%, and the biggest drawdown was 16.6%. That's not very attractive. That's not very attractive trading. That's hard to do. That's hard to take that 16.6% drawdown for about a 5% return. Now, the second one is to buy and sell on a measured move. And now all of a sudden I've got returns that are 17.1%, but I still have that big drawdown. It's about 5 trades per year with 80% winning trades. Not bad, not bad. A big increase over just buying and holding. Now the third one then is to use the measured moves, but then exit when Fibonacci extensions are saying, hey, this is a little overextended. All of a sudden we have 20.3% annual return, and we have really reduced the drawdown to 4.3%. We have more trades, and the winning percent is still pretty high, pretty high. The last one, I'm going to use measured moves. I'm going to exit at Fibonacci's of 127, but when it gets to be overbought, oversold based on the regression channel, I'm going to get out. 24.2% annual return. Drawdowns very low. Not as many trades, but a very high probability of trades of winning. This is what you want to do. This is returns on just buying and selling the ETF SPY. What I do is utilize that information and trade credit spreads. Credit spreads are, you can get great returns when coupled with high probability trades. They yield high monthly income on a consistent basis. We are sellers of premium, okay? We're like the casino owners, and the people that are buying these are the players that are coming in. We have an edge. Time is on our favor. With credit spreads, you don't have to constantly watch the market. It's a low anxiety trading strategy, and you do have protection against loss because you're selling an option, but then you're buying one further out of the money for protection. There's two types of credit spreads, bull puts and bear calls. Bull puts is when you think that the market is going to go up. And what you're going to do is you're going to sell one out of the money and buy one further out of the money for protection. Now, basically when you put this trade on, you're going to sell one option and then buy one further out of the money, and you get the net credit of the two. You say, well, why don't I just sell naked here? Before traders, first of all, your broker is going to require a very high level of trading skill. The second is they're going to require a very high margin. So the return on margin of a credit spread is actually better than return on margin if you were just selling naked. That's a bull put. A bear call is just the opposite. If you think the market is going to be heading down, what you want to do is you want to sell a call here and then buy one further out of the money for protection. The beauty of credit spreads is you have 3 out of 4 ways to win. If we look at this bear call, we're looking for the market to go down. Well, if it does, we're going to profit. If it goes sideways, we're going to profit. If it goes slightly up, we're going to profit. The only way we're going to lose if it goes completely against this, and one of the rules I use is when I get a measured move against me, I will get out. I never take these all the way till expiration. This is the market basket of stocks that I watch. I look at what I call the big four: Amazon, Google, RUT, and SPX. You'll notice that they trade, the prices are very high, and you get excellent credit on these when you trade a monthly credit spread. The other is what I call financially strong stocks. Every year I go through the stocks and call out the ones that have the best market sectors and are performing the best. Apple, Abbott Labs. This is for this year, 2022. Clorox, Costco, John Deere, Danaher, and so forth. This is the group that I follow, and that's all that I follow. I don't look at the 7,500 publicly traded corporations. I just follow this group, and I'm so familiar with these, I could pretty much close my eyes and tell you exactly what the chart looks like. And you get to know these stocks, and that's another edge in your favor. So what I want to show you is what I do every morning when I come down into my study to prepare for the trading day. And what I'm going to do is I'm going to go over to my Thinkorswim platform. I happen to think it's a very good platform. I'm not associated with them, but I just want to show you what that looks like. Here's my watch list. Okay, so I'm down in my study and I'm looking at this, and the first thing I do is I take a look at Amazon, and I see, oh, Amazon looks like it might be close to a measured move. So I will be watching. This is Memorial Day 2022. I'll be watching on Tuesday. If the market goes up, Amazon goes up, I will sell a bull put. So now I know what I'm going to do with Apple. Google does not have a measured move, nothing for Google. RUT, we have already gotten into a bull put. You can see it came up, pulled back, made a higher low, higher high. We got in right here. Here's the Fibonacci. I know exactly what I'm going to do during the day if RUT pushes up further. SPX has showed similar format as the RUT, but I'm a little leery on this little down portion, so I didn't get into the SPX. Apple came down to the -2, came back up, made a measured move. We are in a bull put on Apple. Abbott Labs, looks like Abbott Labs, we just got out of a trade that was a bear call that went against this. So we got out and took a slight loss on that trade. Nothing going on Abbott, although it looks pretty close to a measured move. I'll have to look more on that on Tuesday. Clorox, nothing doing. Costco, just finished earnings, going straight up, but no measured move. John Deere, nope, same thing as Costco. Danaher, I'd like to see the 5. See, the green line here is the 5-day. The gold line is the 8-day. I like to see the 5 over the 8. Eli Lilly, we did get in on a measured move here. So this is it passed through the 127. A lot of times when it goes past through a 127, it'll go to the 161, and that's the one I'm targeting right now. MDT, nothing doing. You can see that it got clobbered during earnings. PepsiCo, has been going straight up. Nothing on PepsiCo. Procter & Gamble, this might be considered a measured move. I'll keep an eye on that on Tuesday. Qualcomm, no, not really, because it made a measured move to the downside here. It hasn't made a measured move to the upside yet. Target, nope. United Rental, nope. Visa, possibly on Visa. Okay, so I've got my watch list. I want to watch Visa. I want to watch Procter & Gamble. I want to watch Lilly, Apple, and what was the other one I was going to watch? Oh, the RUT for sure. And there was one other. But anyhow, how long did it take us to go through that list? That probably took 2 or 3 or 4 minutes. Of course, I do this every day. But now I'm prepared for the trading day. I never deviate from that plan. I've got my watch list. I know exactly what I'm looking for if it comes to fruition during the trading day. If it does, I will execute the trade. If it does not, I stay on the sideline. Okay. This is a trade we recently got out of. I want to show you what we did. It was a bear call on the RUT. You saw it on the chart. You can see that RUT came down, made a measured move here, then moved down, and came back up, made a lower high, a lower high, a lower low. All right, we got in right here, and it looks like it was approaching the 127. All right, we took in a net credit of $2 back here, and then I got out with a net debit of 65 cents. I'm never going to take these till expiration. You don't have to worry about assignment. You know, if we have a nice profit, I'm going to go ahead and take it. That's what I did here. I bought it back, came up with a $1.35 profit on one contract, or $135 on one contract. 10 contracts, that's you know, 1,350, 50 contracts. And yes, I do have some people that do this, 50 contracts. I do have to mention that past performance is no guarantee of future results. However, like I said, I've been trading for 4+ decades, and I've been publicly releasing my trades when I see something that I'm going to do for the last 11 years, and I am very profitable. When I do see a trade, what I do is I send out a text and email alert to my members. And here's an example of that RUT, where on 5/9, I said I'm entering a bear call on the RUT, telling you exactly what to do and what credit approximately you're going to get. Then 4 days later on 5/12, I sent out a text alert saying, okay, time to exit, and time to exit at this price. So I tell you exactly what to do. This is both text and email alerts I send out to my members. So how do I do? Well, this is the kind of equity curve everybody would love to have. And I do this consistently, month after month, year after year. And we're just taking a look at from January 2019. I kind of wanted to take a look at it through the pandemic section, if you will. And you can see, yeah, there was some bumps in the road. We had some losers. We had some losing streaks. That's part of trading. But this is a robust strategy, and we just continue to execute it. And you can see what kind of returns we have gotten. We're close to 1,200% on margin. Okay. Well, what's that mean? Well, margin for every contract of a credit spread, you're going to have 100 shares, and usually I go in with a 10-point strike difference between what I sell and what I buy. So it's going to be 10 times 100, or $1,000 per contract margin required by the broker. Okay, and over the 2 years, I have gotten close to 1,200% return on that margin. And this is what I do day in and day out. 10 minutes a day. I look at my stocks. I prepare for the day. I'm ready. When I see, I usually watch the market when it first opens, try to come back in right around noontime, and I like to watch the closing, and that's it. That's it. I know what I'm going to do. If I need to execute a trade, I do it. If it goes against me, I don't do anything. I know to stay out. This is a very simple strategy. It does take time to master, because there will be losers, there will be losing streaks. It does take a little bit of time to you know, learn how to get in and get out. But you're following me. I'm sending you the alerts. I'm telling you exactly what to do. So you can earn while you're learning. So your opportunity is right now to go to www.optionsinfinity.com, become a member. And if you're a member for 3 months, okay, you're going to learn a simple strategy. It's going to get embedded in your mind. We're going to meet together every 2 weeks, and I'm going to show you what I'm doing with every trade. We're going to answer any questions. And then I'm going to send out the alerts when I see something that I'm doing. All these alerts and trades are posted. You know exactly when I get in, when I get out. And like I said, it might take a little bit of time to master. I'd like you to stick with me for at least 3 months. If you're a member for 3 months, I'm going to give you the 4th month for free. Now, I've been doing this for a while. I'm going to end this offer at the last of June 2022. This offer will be off the table. I want everybody to take advantage of this. This is a once in a lifetime deal to come see how a professional trades, learn what a professional does. Be with me for 3 months, get the 4th month for free, and be a successful trader for the rest of your life. I hope you all enjoyed this video. Bye-bye now.